Welcome to the deep dive. If you're here, you're ready to cut through the noise, right?
Yeah.
All that conflicting financial advice. We want to help you start building some serious wealth.
Yeah, absolutely.
So today, our mission is super focused. We're going to build a clear, actionable blueprint. How do you deploy your first $1,000 investment?
Right.
And this isn't guesswork. It's about setting up a powerful, long-term framework from day one.
That's so key because starting with, just $1,000, every single dollar really counts. And the amount of information out there, index funds, crypto, this stock, that stock, it's overwhelming. It can just freeze you up.
Totally. Analysis paralysis.
Exactly. So what you need is a structure, a clear path, not just like more noise.
Okay, so we've looked at two, I'd say, really powerful ways of thinking about this. And they're a bit different, sometimes even contrasting. On one side, we've got Wall Street Trapper's approach. Very disciplined, very focused on concentration, building these powerhouse portfolios, as they call them.
Right, really aiming for impact.
Then on the other side, there's a model from MrFinance. More about balance, structure, allocation. It prioritizes safety and, interestingly, learning, too.
And that's a great contrast to explore. But the big goal here, for you listening, isn't just about making a quick buck on that first 1,000.
Well,
It's about building something powerful, something driven by a long-term disciplined mindset. So we're going to lay down that financial foundation first. Then we'll get into the specifics, the stocks, the ETFs.
okay, sounds good. Let's get into it.
Yeah.
All right, let's unpack this first piece because honestly, it surprised me a bit.
Yeah.
Before we even think about a brokerage account or ticker symbols, both sources basically put up this huge stop sign.
Yeah.
The emergency fund. Why? Why hammer this savings thing before you invest that first dollar? Seems kind of counterintuitive if you're eager to jump in, right?
It does, but it's probably the single most critical step
Yeah.
because it completely dictates your relationship with risk. One source mentioned this really sobering stat. The average American just doesn't have $1,000 saved for an emergency, like a flat tire, a medical bill, whatever.
Wow. Okay.
And when you don't have that safety net, that $1,000 you were planning to invest, it stops being real investment money. Psychologically, it becomes survival money.
Ah, okay.
Yeah.
Survival capital. That changes things. So if
Yeah.
it's survival money, what happens when, the market does what it does? Goes up and down.
Well, that's exactly where the emotional problem kicks in. If that $1,000 you invested is literally the last cash you have, the second your stock drops, even just a little bit, $5, $10,
Irritation.
total panic. You get, as one source put it, emotionally jammed up with the market. Fear takes over, logic goes out the window, and boom, you panic sell. You basically kill the investment before it even has a chance.
Yeah, I can see that. I mean, if I look at something like Tesla, down, 30% this year? If that was my last $1,000?
Yeah.
Yeah, my gut reaction would be get me out before it goes to zero.
Precisely. You're forced to pull the plug because you literally can't afford to let it ride out the dip and potentially recover. Think of it like this. Investing without that emergency buffer. It's like trying to drive a really fast car, but the gas light is on, blinking red.
Right.
You're going to drive super anxiously,
Right.
constantly worried you'll run out of fuel. You're definitely not focused on driving well or, enjoying the ride.
That's a great analogy. So what's the actual buffer needed then? Is there a specific number? And why that amount?
Yeah, the message is crystal clear from both blueprints. You absolutely must save $1,000 to $1,500 before you invest a single cent.
Okay, 1 to 1.5K.
And the focus should be on getting that done fast. Like, act as if your life depends on saving that money in the next 30 days. Really prioritize it.
And the range. Why $1,000 to $1,500? What does that extra $500 really buy me psychologically?
It buys you resilience, peace of mind, basically. Look, if you save the full $1,500, right, and then bam, $1,000 emergency hits, car repair, whatever.
Right.
You still have $500 left. You haven't been totally wiped out financially. You haven't been knocked all the way off, as the source said.
You're not back at absolute zero.
Exactly. That little bit of cushion stops you feeling completely exposed. And it means the money you do eventually invest can actually be dedicated to its real job.
Yeah.
Growing wealth. It's insulated from your day-to-day survival needs.
So this foundation, this buffer, it forces that mindset shift we talked about. We're signing up for the get-rich-slow plan here.
Absolutely. That's the core idea. You gotta understand. Portfolios are built with discipline, not luck, not some viral TikTok tip, not chasing short-term thrills.
Yeah.
The basic rules are pretty simple. Every dollar you earn needs a job savings, buffer, or investment. Be careful with risk. And, critically, don't chase hype, especially if that money is meant for long-term growth. That financial stability just gives your investments the room they need to breathe to compound over time without you freaking out.
Okay, so let's say we've done the hard work. That psychological foundation is there, the financial buffer, the $1,000 to $1,500 is safely tucked away. Now we've got our actual $1,000 investment capital ready to go.
Right, ready to deploy.
How do we structure it?
Right.
Because, like you said, we've got these two really distinct philosophies on the table. One sounds like, I don't know, investing with training wheels, that diversified four-pillar model, and the other sounds way more aggressive, concentrated, focused on power.
That's a good way to frame it. The four-pillar model that comes from the MrFinance source, yeah, it's kind of ideal for a new investor because it forces you to diversify across different types of assets, different risk levels, and importantly, it actually makes you budget for learning.
Oh, interesting. Okay.
Yeah, it breaks that $1,000 into 4 specific buckets, all designed for balance, and like I said, for learning as you go.
Okay, let's break down those buckets. The first one's the biggest chunk, right? Focused on safety.
That's right, core stability. That gets $400, so 40% of your capital. This is your safety net. It's primarily designed to protect your principal.
So what goes in there? Like bonds, savings accounts.
More like low-risk, long-term growth assets. Think broad market exposure, S&P 500 ETFs, you know, like VOO or SPY, or total market index funds. Even really steady, high-quality dividend stocks could fit here.
Gotcha.
The whole point is steady, reliable compounding. Built-in diversification gives you that strong foundation, peace of mind.
Okay, 40% secure.
Yeah.
Moving up the risk ladder then, the second pillar.
Yeah.
The growth engine. That's 30%, $300. This is where we look for a bit more upside.
Correct. This is where you might start picking individual stocks, maybe in sectors with high potential, you know, transformative tech, specific healthcare areas, maybe green energy, stuff with more growth possibility.
Right.
But, and this is critical because you're picking individual stocks now, the sources really stress you need smarter execution. You can't just buy randomly.
Okay, hold on. Smarter execution. Now we're getting into things like candlestick analysis, stop loss orders. For someone starting with just $1,000, maybe just break those down quickly. What are they and how do they actually protect this $300?
Yeah, great question. Super important. Okay, stop loss orders are basically automatic safety nets. You tell your broker, hey, if this stock I bought drops down to X price, just sell it for me automatically.
Ah, okay. Like an eject button.
Kinda, yeah. So if you buy a stock at $100, you might set a stop loss at, say, $90. If it drops that low, you're out. It limits your potential loss to 10% in that case. It stops you from writing it all the way down in a panic, takes the emotion out.
Got it. And candlestick analysis. Sounds complicated.
It can be, but the basics aren't too bad. Essentially, it's just a way to visualize how a stock's price moved over a certain time, like a day or a week. The candlestick shows you the opening price, the closing price, the high, the low. The four-pillar model suggests learning just some basic patterns here, so you're not buying blind, you know. You're looking for signals that might suggest a good time to buy, maybe on a dip, instead of just chasing it when everyone else is piling in. Learning to time your entries a bit better.
Okay, that makes sense. Pillar 3 then, this is the riskiest part, the speculative edge.
Yep. $150, just 15% of the total goes here. This is your calculated risk zone, your play money, almost.
What kind of assets are we talking about?
Could be some of the main crypto assets, Bitcoin, Ethereum, maybe Solana. Or it could be small-cap stocks, which tend to be much more volatile, high risk, high potential reward.
But there's a big warning label on this one.
Huge warning label. The rule is strict. Only invest what you are genuinely 100% willing to lose. If this $150 goes to zero, it should not impact the stability of that $400 core pillar.
Right.
And you absolutely have to track these. Keep a journal. Why did you buy it? What's your exit plan? Be deliberate.
Okay. And the final $150, this is the part I found really fascinating. Learning in tools. Actually investing in your own education.
Yeah. Isn't that great? It might be the highest leverage investment in the whole $1,000. This $150 is earmarked for things like courses, maybe on technical analysis, like we just mentioned, or valuation, or books, or subscriptions to good quality financial newsletters, macro analysis.
Why is that considered an investment itself?
The thinking is simple, but really profound. Knowledge compounds faster than capital. Seriously, that $150 you spend today learning how to value a company or manage risk, that could literally save you thousands, maybe tens of thousands, in mistakes over your investing lifetime.
Wow. Okay.
It pays dividends and competence, right? Not cash directly, but competence, which leads to better cash returns later.
So the four-pillar method, structured, diversified, built-in learning. Training wheels on, curriculum included.
Yeah.
But then there's the Wall Street trapper way, which basically says, forget the training wheels. Let's go straight for the big engines.
Right.
What's the thinking behind that? Why such extreme concentration with just $1,000? Seems risky.
It does seem riskier on the surface. But the argument from that perspective is that if you take $1,000 and spread it super thin across like 10 or 12 different things,
Yeah.
the gains in any one area are going to be so tiny, so diluted that it just won't feel like anything is happening. It won't build conviction.
Oh, okay. Doesn't move the needle enough.
Exactly. So they argue the goal should be to build powerful portfolios that generate profit. And the way to do that, especially starting out, is to heavily concentrate on just 2 or 3 high conviction assets, stocks or ETFs that you really believe in and plan to add to aggressively over time.
So we're focusing our firepower, hoping for bigger initial wins to build momentum.
That's the idea. The core principle isn't put all $1,000 in one stock, definitely not that. But focusing that initial grand on getting, say, a few whole shares of 2 or 3 powerhouses lets you really see them move. It builds your belief, your conviction, and that fuels the discipline you need to stick with it long term.
Okay, let's dive into the first of these concentrated scenarios. This one's betting big on 2 massive global trends, right? Semiconductor tech, the chips powering everything, and this huge healthcare shift driven by weight loss drugs.
Yep, exactly. Future tech meets a health revolution.
And it starts with SMH, the semiconductor ETF.
Huh.
Why an ETF here, not just picking one chip stock?
Well, this is what one source called the cheat code for the $1,000 investor. Look, semiconductors. They're the bedrock of AI, robotics, data centers, smartphones, everything future tech, right?
Yeah, they're everywhere.
But buying the leader, like NVIDIA, that's over $900 a share right now. Most of your grand is gone on one share. So SMH, the ETF, trades around $222. It lets a beginner get broad exposure to that whole high-growth sector without betting the farm on a single, very expensive stock.
Okay, makes sense. And the recommendation is 3 shares. That's about $666. What exposure does that actually buy you inside SMH?
It buys you a basket of the biggest players, instant diversification within the sector. You get NVIDIA, sure, but also Broadcom, Taiwan Semiconductor, AMD, ASML, about 10 or so giants.
So you're spreading the risk within the chip world.
Exactly. The source pointed out, SMH as a whole is up like 28% year to date. That's huge. By buying the ETF, you capture that sector growth, but you lower the risk if, say, one specific company stumbles.
All right, $666 on chips. The second piece of this portfolio tackles that health trend, NVO, Novo Nordisk.
Right. NVO is the Danish company behind Ozempic and Wegovy. Huge player. Currently around $125 a share. The suggestion here is 2 shares costing $250.
Okay, so $666 plus $250. That brings us to $960. Leaves a little change maybe for trading fees or something.
Yep, keeps it just under the $1,000 mark.
Now, the obvious question here. Eli Lilly, LOY, they're NVO's big competitor, right? Mounjaro, Zepbound. Those drugs are massive too. Why does the source pick NVO specifically when LOY seems just as strong?
That's a really good point. It comes down to a couple of things, mainly accessibility and maybe underlying stability. First, price. LOY is trading around $700 a share.
Whoa, okay, big difference.
Yeah. So for the $1,000 investor trying to build a concentrated portfolio, getting 3 shares of SMH and 2 shares of NVO lets you own more whole shares right off the bat. You feel like you have more skin in the game.
Right, maximizing those initial positions.
And second, while the weight loss drugs are the exciting growth story, NVO also has this incredibly deep, long-standing dominance in the global insulin market. That's a huge, stable revenue stream kind of underpinning everything.
So it's got the growth, but also a solid foundation.
Exactly. It pairs that established stability with this aggressive push into what could be a multi-trillion-dollar weight loss market. And you get that package at a much more accessible entry price compared to Lilly right now.
Okay, that rationale makes a lot more sense than just it's cheaper. Now, you mentioned deployment strategy. It's different for the ETF versus the stock.
Yeah, slightly different mindset. SMH, the ETF, because it's already diversified across many stocks, it's ideal for dollar cost averaging, or DCA. Meaning you can just set up an automatic purchase, say $50 or $100 every week or every 2 weeks. Buy a little bit regularly, regardless of the exact price. Because it holds so many stocks, you're averaging out your cost over time. It's safer for consistent buying.
Okay, but not for NVO.
For the individual stock, NVO, the advice is a bit more patient. Use your automated contributions to save up cash in your brokerage account until you can afford a whole share. And then, maybe, watch the price. Try to buy it on a small dip maybe if it pulls back 3% or 5%, rather than just buying continuously at any place. Be a little more strategic with your entry on the single stock.
All right, scenario 2. This one feels really focused on pure growth, maybe even parabolic growth, and companies that have shown serious resilience.
Yeah, this one's definitely leaning into momentum and strength.
And it starts with a big one. Meta platforms, Facebook, Instagram, Threads, the whole suite.
Yep. Meta, currently trading around $525 a share. And the strategy here is bold. One full share. That's over half your $1,000 right there.
Wow. Okay, that is a big commitment. Why is so much confidence in Meta? What's the resilient story they're pointing to?
Well, the sources kept coming back to this phrase. Meta took Apple's best punch. Remember back in 2021 when Apple changed its privacy settings?
Oh yeah, the tracking opt-out thing. That hit Facebook hard, didn't it?
It crushed their advertising revenue initially. Huge blow. But Meta didn't just curl up and die. They recovered and then they rebounded with incredible force.
Wow, what did they do?
They pivoted hard, invested billions in the metaverse with Oculus, which is still a long play. But more immediately, they pushed Reels like crazy to fight off TikTok. And maybe most importantly, they went all in on AI. They're now one of the single biggest buyers of NVIDIA's AI chips in the world.
Okay, so they adapted, invested heavily, and the results...
That was stunning, actually. Stock's up, 49% year to date? And last year, it returned something like 145%. That recovery and pivot really paid off for shareholders.
But for a beginner, why is Meta considered recession resistant? That seems counterintuitive for an ad-based business.
It does, but think about its economic moat, as they say. It's how digital advertising works. If the economy tanks and we hit a recession, what do people do?
Stay home more. Scroll Instagram.
Exactly. They spend more time on platforms like Instagram and Facebook. So companies who desperately need to reach those eyeballs actually have to keep spending, maybe even spend more, on digital ads on Meta's platforms.
Okay. And if there's no recession?
If the economy's booming, people have money to spend, companies advertise more to capture that spending, so Meta kind of wins either way. It's surprisingly resilient to the economic cycle.
And there's that whole TikTok angle too, right? The political stuff.
Absolutely. That's a potential catalyst. If the US government puts more regulatory heat on TikTok, forces changes, or even bans it, who benefits most?
Meta and other US social media companies.
Right. They're perfectly positioned to scoop up users and add dollars if TikTok gets hobbled. It's another layer of potential upside.
Okay, so over half the portfolio in Meta. What's it paired with to complete this $1,000 growth strategy?
It's paired with CELH, Celsius Holdings, the energy drink company.
Celsius. Interesting choice. Why them?
CELH has been a monster performer, a major disruptor in the beverage space, specifically energy drinks. It's shown absolutely exceptional growth, priced around $83 a share currently. The recommendation is 5 shares.
5 shares at $83, that's $415. Plus the $525 for Meta gets us to $940 total, still under the limit.
Yep. So this portfolio combines Meta's dominant high-margin advertising business with a consumer staple energy drinks that's in a high-growth phase itself. Celsius has delivered incredible returns, up 54% year-to-date alone. It's a pairing of tech dominance and consumer momentum.
Okay, scenario 3. This one feels different again. It's trying to balance things out more, maybe. Pairing massive disruption with, old-school solid stability.
That's exactly it. It's about finding assets that might perform well in different kinds of markets. Starts with the ultimate disruptor, AMZN, Amazon.
Can't get much more disruptive than Amazon.
Right. The A to Z everything store. They just pressure every industry they touch. Stock's around $184. The play here is 3 shares, costing about $552.
Okay, up 22% year-to-date. Not bad. But the sources emphasize it's not just about online shopping anymore, is it? Where's the future growth coming from for Amazon?
Yeah, it's way beyond just selling books or gadgets now. The sources highlighted 3 big drivers. First, obviously, Prime. Amazon basically rewired our brains to expect next day, even same-day delivery. That forces every other retailer to try and keep up. It's a huge competitive advantage.
Okay, logistics dominance. What else?
Second, robotics and AI. They're already using sophisticated robots in their warehouses like crazy, cutting costs, improving efficiency. The expectation is that tech eventually moves beyond the warehouse, maybe even into our homes in some form. They're pushing the envelope there.
Right. And the third one, this one seems like a curveball.
Healthcare.
Yeah, it sounds weird for a retailer, but it's incredibly strategic. Amazon bought PillPack, the online pharmacy. They bought One Medical, the primary care provider.
Yeah.
They own Whole Foods, so they're piecing together the infrastructure.
Exactly. They can leverage their existing logistics, the warehouses, the delivery network, even Whole Foods locations to offer things like same-day prescription drug delivery. They're already doing it in places like New York and California. That puts direct pressure on the old guard like Walgreens and CVS. They're weaving healthcare into their delivery mode.
Okay, so Amazon brings the aggressive, tech-driven, disruptive growth. What's the counterbalance? the stability part.
The stability comes from BRKB, Berkshire Hathaway, Warren Buffett's company.
The classic. Makes sense for stability.
Right. One share of Berkshire B, priced around $400 or so, rounds out this portfolio, keeping it under $1,000. Berkshire provides that rock-solid balance because its holdings are so incredibly diversified.
How so? What's inside Berkshire, really?
It's a mix of wholly owned private companies, think these candies, Dairy Queen, big manufacturers, plus huge operations like the BNSF Railroad, major utility companies, massive insurance operations like Geico, and then on top of that, a huge portfolio of public stocks like Apple, Bank of America, Coke.
Wow, okay. Truly diversified. But why does Berkshire's massive cash pile matter for someone investing just $1,000?
Yeah.
They mentioned it sits on like $161 billion in cash.
Yeah, it's an insane amount of cash, more than Apple, Amazon, and Google combined. For the small investor, what that signals is incredible resilience and optionality.
Optionality?
Yeah. When the market eventually crashes or we hit a really bad recession, companies are struggling, stock prices are plummeting. What's Berkshire doing?
Sitting on a mountain of cash, ready to buy.
Exactly. They're perfectly positioned to scoop up great assets, maybe even whole companies, at bargain prices while everyone else is panicking or scrambling for cash. It allows them to get even stronger during downturns.
So the strategy here is the contrast itself. Amazon is the aggressive tech, AI, robotics, disruption bet. Berkshire is the steady, diversified insurance policy that just keeps chugging along, maybe even thrives when the tech sector takes a big hit.
Precisely. It's a portfolio diversified not just by company name, but by economic function, designed to have components that work well in opposite environments.
Okay, we've got the mindset right, the emergency fund sorted, and we've explored these different portfolio structures, the balanced four-pillar or one of the concentrated approaches. Now, the crucial part, how do we actually do this and keep it going beyond that first $1,000?
Yeah, the execution. Because that $1,000 is just the starting pistol, right? It's the seed. You've got to keep watering it.
So fueling the portfolio regularly.
Absolutely. And the single most important mechanical step, according to the sources, automate your future contributions. Set it and forget it.
Why automation? Why not just decide to invest when I have extra cash?
Because you have to take the emotion, the decision-making out of it. If you wait until you feel like investing or until you think the market is right, you'll likely miss out or make emotional choices. Just set up an automatic transfer from your checking account to your brokerage account every week or every 2 weeks, whatever fits your pay cycle. Make it happen without thinking.
Okay. And the sources gave some guidelines on how much to automate, right?
Yeah.
Based on how aggressive you want to be.
Yeah, they laid out 3 tiers, kind of goals to aim for. The active rate is saving and investing 10% of your paycheck or business income. Strong is bumping that up to 20%. And the really aggressive big dog tier is aiming for 30% or even more.
30% is a lot.
It is, but the core idea is consistency. Even if you start smaller, maybe not even 10% at first, that consistent automatic funding means you're buying shares in good markets and bad markets. You benefit from dollar cost averaging naturally just by being consistent.
Okay, so funding is automated. Kick. What about optimizing the buying itself? Especially for those pricier stocks in the concentrated plans like Meta or Amazon. You can't always afford a full share right away.
Right, so once the money is flowing in automatically, you need a plan for when to actually click buy. Again, remove the emotion. The sources suggest setting predefined rules.
Like what kind of rules?
Could be price-based, like I only buy a share of SMH or NVO if the price drops, say, 3% or 5% from its recent high. You're looking for those little pullbacks.
Okay, buying the dips, basically.
Kinda, yeah. Or it could be threshold-based, like every time my automated deposits build up $500 in cash in the account, I use that cash to buy one full share of whatever stock is next on my list, like Amazon or Meta.
So it's systematic, not just buying whenever you feel like it.
Exactly. Stops you from chasing highs or panic buying.
Now, for the listener who really needs that step-by-step guide, that MrFinance source had a really practical 7-day execution plan. Kind of gets you from zero to invested in a week.
Yeah, that plan is great for cutting through the where do I even start feeling. It breaks it down simply. Days 1 and 2 are just research and setup. Open your brokerage account, make sure it's low fee, and crucially, set up some way to track things. A simple spreadsheet, a dashboard, whatever. Just document your starting point.
Okay, days 3 and 4.
That's when you make your main investments. Allocate your core and growth. If you're doing the 4-pillar, buy your core ETF or index fund. Then pick your 2-3 growth stocks. Research those entry points we talked about. Maybe you wait for that small dip.
And the risky stuff.
Day 5 is your speculative entry. If you're doing the 4-pillar, pick your crypto or small cap. But, and this is vital, immediately set your price alerts and absolutely those stop-loss orders we discussed. Manage that risk from day one.
Don't just throw it in and hope.
No. Then day 6 is education investment. Buy that book, subscribe to that newsletter, enroll in that course. Invest in yourself. And finally, day 7 is journal and reflect. Write down why you chose each asset. Review your first week, and importantly, set goals for reviewing your portfolio maybe once a month to start.
That's a solid week's work. But okay, we have to tackle the elephant in the room when you talk about stocks like Meta at $525 or Amazon at $184 fractional shares. What's the verdict there? The sources seem pretty strongly against them.
They were very clear, yeah. The advice was basically avoid fractional shares.
Why, though? If I only have $100 for my automated savings this week and I want Amazon, isn't owning like 0.5 shares better than owning 0 shares? Seems like a good way for beginners to get started with expensive stocks.
That's the common argument for them. But the perspective from these sources is different. They see fractional shares less as a tool for real ownership and more as a game invented to get you playing a game. Meaning it gives you the feeling of participation, the dopamine hit of owning Amazon, without the reality of meaningful ownership. You get like a tiny fraction of an already tiny dividend, if there is one.
Okay.
More importantly, psychologically, they argue that saving up the full $184 or $525 to buy one whole share builds better discipline. That process of save to invest, waiting until you can afford the real thing, that discipline is actually more valuable for your long-term success than the instant gratification of owning 0.1 shares. Seeing one full share in your account also provides better visual confidence, they argue.
Huh. That reframes it completely. It's about building the habit of saving for a goal, not just instant access. Okay, last piece then. Scaling. How do we grow this beyond the first $1,000 and the initial contributions?
Yeah, how do you accelerate? 3 main things came up. First, obviously, reinvest everything, all dividends, any profits you might take eventually, though the focus is long-term holding. Plow it all back into the portfolio. Let it compound.
Makes sense.
Second, keep up those automated contributions, ideally increasing them over time as your income grows. That $100, $200 a month or whatever you set is the consistent fuel. Third, maybe explore other ways to generate income specifically for investing, like passive income streams, maybe affiliate links if you have a blog, selling digital products, offering a service on the side. Funnel that extra cash directly into the investment account.
And the pitfalls to watch out for as you scale.
The same ones that trip up beginners, honestly. Overtrading is a big one.
Yeah.
You don't suddenly need 20 different stocks just because your account is bigger. Stick to your strategy, whether it's the 4 pillars or your 2-3 concentrated powerhouses. Don't get distracted. Ignoring fees as your account grows, even seemingly small fees like expense ratios on ETFs or trading commissions, if you're not careful, really start to add up and eat into your returns over the long haul. Be mindful of costs.
And the biggest one.
Always emotional decisions. Fear and greed. Getting scared during downturns and selling low, or getting greedy during bull runs and buying high, chasing hype. Those 2 emotions will absolutely destroy even the best laid plans or portfolio structure. Discipline trumps emotion, always.
Fear and greed, yeah, definitely the twin enemies of that get-rich-slow, disciplined approach we started with. Hashtag tag outro. Okay, so we've really broken down a clear, actionable blueprint here. How to build that first $1,000 portfolio. The core takeaways feel really solid. First, that non-negotiable $1,000 to $1,500 safety net. Got to have it to invest without emotion.
Absolutely critical first step.
Second, you've got a choice and strategy. The balanced, learning-focused 4-pillar framework or one of those more aggressive, concentrated growth models. Depends on your style.
Yep, know yourself as an investor.
And finally, the mechanics matter. Automating your contributions, having a plan for buying, reinvesting everything.
Yeah.
That's how you fuel the engine over time.
Yeah, that first $1,000 you invest, it's more than just money. It's really a message you're sending to your future self. It says, I started, I believed in this, I built something. It starts with the savings habit, and then the compounding comes from that consistent emotion-free discipline we talked about.
Right. So here's our final provocative thought for you listening. We laid out those 3 concentrated portfolio examples. The future tech healthcare one with SMH and NVO, the parabolic growth energy one with Meta and Celsius, or the disruption stability one with Amazon and Berkshire. Thinking about the rationales, the risk levels, the kinds of companies involved. Which of those 3 best aligns with your personal investor identity? Your vision for the future, your tolerance for risk.
Yeah, which one resonates?
Figure that out, understand your philosophy, and then take immediate action. Start building that $1,000 savings buffer today. That's where the journey truly begins.
Self-destruct sequence activated.